Hi everyone, hope you're all doing well, and today we're going to talk about if you are down 50% on the stock, is it time to panic sell? And the first thing I'm going to say is obviously, no, don't panic sell. There's a few things we're going to go through, and hopefully if you are down maybe not even 50%, but 20, 30, 40% on the stock, hopefully this video does help you about the correct process to go through if you're down on the stock. Now, I think a few of these, I think at the moment, because the stock market, especially on the tech side, has had such a hard correction, and also that obviously the tech stocks been here, but especially more of the like spec stocks. And I think a few people might have been buying a few of these spec stocks at all-time highs, and then it's so quick when you're buying at a spec stock in an overvalued markets, it just snapped back so quick and you're down on your position quite a bit. So hopefully I'm going to help you with that if you are in that situation, what to do right now, because I have had a few people in the comments, I've had a few messages as well about people slightly worried about the situation that they're currently in because they've got a stock that has gone down quite a bit. So hopefully a bit more of an education video for you guys today, so hopefully you do enjoy it. If you could smash the like button, if you are new, subscribe as well, that'd be absolutely amazing. If you do want to know when I'm buying and selling companies, and there's also 2 exclusive videos a week on there, join the Patreon. There's all that, there's a Discord on there, so the link for that is in the description. If you do want to start buying some shares, there's a link to a free trade account in the description below as well. So we're going to talk about this being down on the stock. There's a few things I'm going to say before we get onto it, and then I'm going to talk about 3 different scenarios that could happen and what I would do personally in them scenarios. Two were kind of like previous experiences that I had, and the third one is something a little bit more different. So first of all, let's say you've gone down on a company. The first thing that I would say is that you'll have a lot more confidence if you're down on a company if you know your company. If you know your company in and out, you'll have a lot more confidence, because if you know your company really well, you'll know how strong of a position that company's in, how the company will do in the long term, because you shouldn't get worried about short-term movements. If you're a long-term investor, you should be thinking about the long term. And if you know your company in and out, quite often if your stock goes down 30, 40, 50%, and it's only some short-term bad news, and you know your company's going to really perform amazing long term, you should be like scratching your head like, why has it dropped so much? I'm just going to buy more. And if you're in that position, that's a great thing to be in, and that's what sometimes I see, especially over the last few months, is sometimes, especially on the YouTube scene. I mean, even me, like if I say a company, don't just buy a company because I say so. Always do your own research into the company, because if you buy a company off someone else's word, then when it goes down, you're going to be like messaging them like, why is this company going down? Is it going to go back up? But if you've done the research into the company, you'll have so much more confidence to know what's going on, and a dip won't worry you. And if it's a good company and you're still really bullish on that company, if it was to go down, you'd be buying more. So definitely know your company, and drops won't affect you so much. I've got to say as well, I think like especially on the newer guys that might be in the stock market the last kind of 2-3 months, all you've kind of known is the stock market that's gone down as well. So I think this video might be quite good for you. Second thing, one of my biggest rules is not to buy at 52-week highs. Sometimes I will. There's a few exceptions for that, but most of the time I don't buy at 52-week highs, because the first thing that happens is if you buy at 52-week highs, you're the first one to get stung if the stock goes down. But I like to try pick up stocks even on a 5% dip, 10% dip, and then my favourite thing to do is if a company brings out bad news and the stock kind of drops 10, 20, 30%, and I'm looking at that company and I'm like, but it's still going to do very well in the long term, then that is my absolute favourite to go buy a company. Like when something's hurt the stock price that's only going to affect it in the short term or has already affected it, then I'm like, okay, this is a golden opportunity. But I don't like buying at 52 highs, and that always saves you as well from being stung. The only time I will buy at 52 highs is because quite often at 52 highs you have a very rich valuation on the stock. But the only time that I will buy a company at 52 highs is if I look at the valuation and I'm like, that's still really cheap. Like if I'm looking at a company and I'm like, one of the big ones was InMode. So InMode had already gone up, like since the CV dip had already gone up 100%. But I was looking at the company and I was like, the valuation is still cheap. Like the forward PE ratio was like 17 still, and I could see the revenue growth and the profit growth, and I was like, a company like this shouldn't trade at this valuation. And I bought that one at 52 highs, and I'm up over 100% on that one now. There was a point where the company did dip like 5% after me buying at 52-week highs, but then I just doubled my position even more, because I was like, if it was to drop, I'm just going to load the boat. And that's the only time. If I still look at a company at 52 highs and I think the valuation is still crazy cheap, and if it was to dip, I would just even load the boat even more, then that's absolutely fine. But most of the time I will wait for a little bit of a pullback for me to buy in, and that's definitely, I guess, the key thing as well is just, manage your valuations. At 52 highs, normally valuations are just really expensive, so just be really careful of that. The next point is averaging. Averaging in is the best way to buy a company, in my opinion. Now, the big problem we've had over the last I'd say probably 4 months, is the stock market literally just went straight up. And that made it a nightmare for averaging into companies. You were literally buying companies and next day you're already up 10%, then 20%, and you couldn't really average into positions. And even averaging up was the valuation is totally different from where it was 2 weeks ago. And that was one of the problems we had. In a normal market, which looks like we're starting to get that right now, you can normally average in over a course of a couple of months, maybe even longer than that. And then that will give you a really good average. So you just buy, I'm going to buy 25%, this week. 3 weeks later, another 25%. 3 weeks later, another 25%, And then over the course of a period, you'll get a good average. And if any dips do happen, them dips will actually bring your average lower. And then you'll make more money in the long term. And sometimes what I've seen is quite often people just gone all in at once. And especially, the last kind of January and February, they've gone all in at 52 highs, boom, they get stung. So as always, best way is to average in, and you'll probably get a really good average from doing it that way. So hopefully these little tips helped you with avoiding this situation, but sometimes it still happens. And sometimes, no fault of your own, stocks will go down. Some news might come out, it might be a stock that you've been holding for even a few months now and you've fully built your position, and then bang, it goes down. So this is kind of some different situations that I would be in if I'm down on a position. So the first one, this happened to me in 2019. So I started buying a company, and this company was called Tesla. So I'm sure you've heard of it. So I started buying this company in 2019. Tesla was in a strange place in 2019. I think this is when it was, if you take the split and everything, it would have been $40 I bought in at. And I bought this company. Seemed like everything was going to go, really well. Had so much good stuff going on the EVs. But then the stock went down 30%, and there was a lot of worries about Tesla running out of money, struggling with production. I think at the time, Elon Musk was sleeping on the floor of the factories. There was a fire in the factories, and the stock had a pretty awful 2019. So yeah, I ended up being about 30% down on the position. And I looked at Tesla and I thought, well, I did all my research in the company, and I thought they've got easy to raise cash, and in fact they are very close to profitability now, which now we know that in 2020 they actually went on to have a very good profitable year. And I was like, so in the long term, I don't think they're going to struggle with cash. I think they're going to be profitable very soon, because I know the company, I did the research. And I think that some of the stories were just exaggerated. And because I had the confidence in the company, and because I had confidence in Tesla, and I was down, 30% on at the time, I said 300%, 30% at the time, all I did was thought, I've kind of fully built my position, but I'm looking at the upside now, and I think it's even more upside. So for that one, I just held it, and I just bought in, and in the long term, I thought it's still going to do very well. And from there on, obviously now 2021, I think from that point the stock is up over 1,000%, I think it is. And yeah, that's the first one. That's the first one of knowing my company, knowing what's going on, and then having belief of okay, the news that's coming out is just all over exaggerated, short term news that's only going to affect it, and I think it's going to do very well in the long term. And because I knew the company, I made even more money on it. So that one was like a dip where it gives you even more chance of making money. And so that's the first one. My first example is that where you know the company and you still think it's going to do very well, keep averaging it. So my number 2 example is a stock that I was actually down 80% on. So this company was CCL, or Carnival Cruises. So this is a company that I actually bought in 2018, I believe it was. If it wasn't 2018, it might be in early 2019. So I was doing okay on CCL. It was doing okay. Played it as a bit of a value play, a bit of a dividend play. 2020 comes along, CV happens, shut down, cruises shut down for absolutely ages. Now, the full outcome hasn't happened to this one yet, but you kind of get the gist of it. So I looked at this company and I was like, so the company, the share price, I was down 80% on this company. And I looked at this company and I was like, okay, has this company, I knew the company really well, but I was then thinking, has the company changed slightly? And I was like, yeah. So the thing is like, they're not going to have as many ships when they come back to normality. They're also taking on a lot more debt, a lot high interest debt. So the company's not going to be in the same place as what it was. You know, when we looked at the first example, Tesla was only going to get better and better and better. So I averaged in. I looked at this one at 80%, and you know, I could have panic sold at 80% down and gone, oh, I'm just going to leave it. But I looked at this one and I was like, will it go bankrupt? No, they'll be able to raise cash. You know, when you've got so many assets like ships, they're okay. So we don't need to worry about it going bankrupt. When things come back to normality, will they carry on growing revenue? Yeah, maybe not as much because they don't have many ships, but it'll come back growing revenue and it'll still be here. Profitable? Yeah, it will go back to being profit. Obviously, probably not as much because it won't have many ships and it'll have a lot more debt to pay down. But the company is still going to be okay. Not as good as the first example. But however, this one here, I still think like it's an overacted drop. But I have to say I don't like the company as much as what I did when I bought it. So I looked at CCL, down 80%, and I was looking at that one. And I thought, the long-term game plan isn't as good. You know, when I looked at Tesla, I went on to make a lot more money from that one. I was like, the game plan is still very good in the long term. I thought, okay, the fundamentals have changed slightly, but this still, to panic sell now would be the worst time. This would be the worst time for me to sell because it's going to come back in the long run. However, I don't like it as much as what I used to like it. So I looked and I thought, well, right now it's definitely, you know, if I was to panic sell at 80%, don't make sense because I'd lose a lot of money and I think this is going to recover. Don't get me wrong, don't like it as much, but I think it's going to recover. So I did buy a tiny bit to average down, not as much as back here because I love this company, but here I brought my average down just slightly. And I thought, when this gets to break even, I'll take my money. Now, the outcome for this one hasn't happened. I use this as an extreme example. But right now, from me doing that and just thinking, okay, I think it will recover and I won't buy as much because I don't think the future's good, but I'm definitely not going to panic sell here, but I think it will recover. I'm now down about 20% on this one. So I'm about 20% off where I will get to break even and I'll be able to get my money back and I wouldn't have panic sold and I would not have lost any money. So that just comes, you know, down to, you know, time, knowing the company will recover. And I've gone from panic selling at an 80% loss to only being down 20% now. And I think in the next 12 months, I would have avoided taking an 80% loss on the stock, which is, I think, pretty good to do. So there's the first example. First example of a stock that I love, buying heavy, got the rewards. This one is a company where the fundamentals have changed, but I still think it was a dramatic drop and not panic selling being down a huge amount. So the third one, let's say it's a bit like this one. Let's say XYZ, the fundamentals have changed, massive to this one. Now the big thing is, for this one, is ideally you want to try spot that things have changed before everyone else notices them. Sometimes you can't do it, you know, don't get me wrong. You know, if a company's gonna say a short report comes out about a company you own, you're not gonna know that's gonna happen, and you know, that might affect it. But sometimes if you start seeing, oh, I don't like how management are doing that, I don't like how they're not growing this, you know, I don't like how the growth's slowing, the valuation's too much, you want to try and notice them before everyone else is. But sometimes you can't, and sometimes, you know, you get stung and it goes down. So let's say something's changed this company, you didn't notice it, the stock has now dropped and lost half its value. So depending on what's changed, you've got to kind of justify and know your company and think, okay, is that an over dramatic drop and it's worth holding and averaging in even more? And when it gets to break even, which you think it will do, then you take your profit and you run. However, sometimes, the very rare time you look at a company and you go, okay, that is actually really bad, I'm going to go sell my company at a loss. That's the worst case scenario. And I would only say the only time you should do that is when you look at that and think, I actually think the reaction is not enough. You're actually like, oh, that's actually seriously bad news. So let's just say it comes out that a company has been lying about its revenue, and that's quite serious. If a company lies about revenue or the amount of cash it has in this company, very serious stuff. And that is an X, Y, and Z where you should run to the hills with that. If a company has been like fraudulent about something, that's normally a big serious end for a company, and that would be a time where you should run whatever's going on. However, let's just say, for example, XYZ, a short report came out and said that your production target for a product is not going to be there, it's going to be slower, and the company comes out and goes, yeah, the short report's actually right. But the thing is that company's still going to produce a product down the line. And then when that product's produced, the revenue will come up. And at that point of view, you'd be like, okay, so it's not the end for this company. It's still going to do what it's going to do, not as good as what it should be. I don't like how management lied. I don't want to be involved in this company anymore. But then you panic and sell, because that's already been priced into the share price. So you could be looking at that one and going, I'm going to actually sell that out down the line, average in, and then run from it flat. And that could be something you do. That's kind of like that situation. Not as serious, because the company weren't lying about anything or something like that. But X, Y, Z have changed, and you want to get out of the company. But in the long term, some people will still come in and buy this company, and you can get out flat, and you don't panic sell. So it comes down to two different things really on that one. It's really tricky. It's one where you have to take every individual stock into account and decide how serious it is. And like I say, the only time I would ever panic sell from a stock is where you're like, okay, that actually could be the end of the company. If it's bankruptcy fears, if it's the company being fraudulent about numbers, those are probably the two serious things the only two where I would totally panic sell and just run. Everything else, if it's from something just going wrong in the company, maybe losing a partnership, sure, the company's not going to be the same. The fundamentals have changed, XYZ have changed, but a lot of that will already be priced in, and it would be the worst point to sell the stock, and there will be some recovery in the long term, and the rest of the company will carry on growing and replace the damage that's been done, and you probably get out break even. Quite often, a loss is only a loss when you actually click the sell button. It's only a paper loss. And the thing is, in the long term, most stocks that grow revenue and profit will go up in value. Even if you have a company that's been hurt and they've lost a customer and they sink down in share price and the revenue is going to sink down for the next 12 months, in the long term, if they can come back to growing the profit and revenue, investors will come back in and you don't have to take that paper loss. And X, Y, and Z might have changed the company now, and you might not like that, and you think, okay, I don't want to hold it as now what I did do, but you can get away with not taking a loss. And that's the thing. So hopefully this video helped you with 3 different cases. Hopefully, one where you're thinking, I'm just going to buy more because I love the company. One way the fundamentals have kind of, changed a little bit, but definitely the worst time to, sell a company, and you can definitely get back to being break even. And also the one if you got something that fundamentally kind of changed with the company that you don't like. But yeah, hopefully the video was a bit useful anyway. I think a few guys kind of wanted this one because I know some of you guys might have got in at maybe all-time highs and down quite a bit. So hopefully you enjoyed it anyway. If you could, smash the like button if you are new, subscribe, and I'll see you on the next video.